The broadcast is now starting. All attendees are in listen-only mode.
Hello, good afternoon, everyone, and welcome. My name is Aubrey McLaughlin. I'm the Director of Alumni Professional Networks for the University of Maryland's Alumni Association. We're excited you're able to join us for the third week of this financial planning series, Springing into Action, a series on financial wellness, presented by Rey Calvello, graduate from the class of 2008, and Tim Carroll, graduate from the class of 1987. This webinar is part of the Alumni Association's Professional Development Webinar Series, in which we hope to provide thought-provoking and valuable content that helps alumni like you achieve your personal and professional goals. This is a 4-week series with information building from week to week, and we are hosting the final week of this series next Wednesday, May 30th at 12 p.m. We have a lot of information to cover today, but we will be taking questions at the end. Feel free to submit your questions at any time using the question box that is located in the GoToWebinar control panel. Rey has been with Independence Planning Group since 2010 and has been in financial services altogether for about 10 years. Rey has built a niche with physicians, CRNAs, nurse practitioners, and physician assistants. He enjoys establishing a process and sense of financial stability for their short-term retirement and legacy objectives. Rey also enjoys presenting to business owners and their employees through financial wellness workshops. Tim has also been with Independence Planning Group for 10 years. He is a registered representative with Park Avenue Securities and an agent of the Guardian Insurance Company. Tim works with individuals and families. In addition, he focuses on small to medium-sized businesses in the area of business maximization and succession planning. Tim utilizes his 25-plus years of experience in running businesses and taking them to the next level. And now we'll get started. Rey and Tim, take it away.
All right, thanks, Aubrey. And, hello again, everyone, and thank you for those of you who are joining us again. And this is our third week of our 4-week series, as Aubrey mentioned, and we do appreciate you back and spending an hour of your time on this busy time of year around Memorial Day. A lot going on, I'm sure, for you and all you out there. An exciting time for us Maryland Terps, too, with the if you're a lacrosse fan, with all we got going on this coming weekend, and Final Four for the women and men's lacrosse teams. So if you're into that, it's an exciting time as well. So again, we want to thank you, and for those of you who are new to the program, again, this is the third of a four-part series. The other 2 parts you may have not been with us are now available on recording. So, and Aubrey can explain that to you later on as well, if you happen to miss the first 2. But as far as today goes, we've showed you now in the first 2 phases how you can keep pace and outrun the real cost of living and not rely on that elusive investment risk, which is based on return that may or may not unfold in your life. And this way, you're putting you and your family in control of the levels of savings and saying no to excessive risk taking. And with the first 2 steps that we now have in motion, solid protection and then a high level of savings, we're going to take a look today at step 3, which we'll get into in a moment. And that's deals more with how to build that life events fund. So first of all, before we get into that, we want to just remind you, and some of you have already taken advantage of the value we bring with wealth steps, and taking a look at the summary you have in front of you. If you were to log on to your wealth steps site, you can create this and go through the 4 different steps of wealth steps and kind of get a scorecard for yourself, kind of see where you stand just by providing basic information on that, and gives yourself a scorecard. And as a reminder, for those of you who have not taken advantage of this value offering we have right now, feel free to do that, and this can provide you with a scorecard similar to the one you see in front of you there, and just kind of see where you stand. Then from that point, you can, again, reach out to Rey or I and provide a consultation for you as well, and take you to that, level and explain in more detail what we can do to help you out there.
This is Rey. Welcome, everybody. Thank you. And just a little bit about ourselves and Independence Planning Group since 1987. Just let you know that we have wealth step specialists all over the country. Yes, we're located in Pennsylvania. We do work with people all over the country. So anybody that may be thinking, oh, well, they're so far away, that's okay. We have associates all over the country that we can connect you with that are wealth step specialists and financial professionals. So just wanted to throw that out there. Moving forward, let's start our step 3 webinar today, Life Event Funds, a closer look. And life, as we start, has a lot of different things that changes how our life kind of moves, and there's sudden changes that sometimes we're ready for, sometimes we're not ready for. and some can be significant or catastrophic. So it's important that as we're preparing financially, we're prepared when and if those changes in life actually occur. So we're going to talk about, as a review, we've already talked about the real cost of living, not just the impact of inflation and taxes over time, but everything you surround yourself with in your home and your life, things that have a lifespan attached to them, say your cars, the shingles on your house, clothing, carpets, everything that you buy must someday be replaced due to wear and tear. And while things are wearing out, there are new inventions that do not exist today that you'll like to own, like a computer or our iPhones that 15 years ago we didn't know about. Improved technology that's going to come out. Goods and services that are rushing towards you at a fast pace. There's also the idea of wanting to have a better life tomorrow than you do today. Some people like wine, longer vacations, more rewards for the hard work and good financial decisions they're making. All those things tend to take money off your balance sheet quietly and perhaps not so subtly. Included in that list makes it difficult to build wealth for your tomorrows. You must consider planned and unplanned life events. And that's what we'll be talking about today in greater detail. And consider this image here. Here you're moving through time, trying to do the best you can to manage your finances. And as you look above, there's this amount of capital that you've been able to save or invest and have been able to hold on to. What this birdcage represents is the fact that most of it is illiquid. It's not necessarily as available to you to respond to a sudden life change as it should be. Okay, so as we talked about life events, we like to talk to our clients about two types of life events, and those that are planned and those that are complete surprises. Those under the category of planned life events, things like starting a family and buying your first home, sending your kids to college, possibly one day, someday having that great day when your children get married. All of that is baked into what people's typical life journey amounts to, like on their way to retirement. It's not just here today and someday retirement, and someday you'll retire. The idea that you have an eye towards your retirement because you will have significant financial life events that will pop up and create some sort of roadblock as they will stand in the way of your ultimate retirement objectives. So how do you consider planned life events, things like college, weddings, buying a home, if all of your money is locked up and out of reach and inaccessible, allowing you to be unable to respond to those events when they happen?
When you throw into that mix as well, the possibility of an unplanned event, things become a little more complicated, such as maybe you have an automobile accident that results in an injury or disability where you can no longer work. Or maybe a tornado, hurricane, some kind of natural disaster destroys the property that you spent years accumulating. Again, things we've talked about over the last couple of weeks. Or maybe it's just aging parents who outlive their wealth and require your financial assistance. Maybe you're downsized at work. You have to take 6 to 12 months to re-enter the workforce, and maybe when you do re-enter the workforce, it's not at the same pay scale that you previously enjoyed. Things happen. Accidents, people get sued, short and long-term illnesses. They're not the things that can be predicted in the timing or the scope. They may not be predicted as well, but they have to be considered when you try to prepare in advance to respond and protect your financial journey along the way. So the combination of these known, highly likely planned events on the left, along with these surprises in life that cause you to reconsider your cash flow decisions, to make sure you have the ample levels of liquidity at all times. That's what we're going to talk about. Now let's look at the definition of liquidity. By definition, liquidity as it relates to your financial journey should be making sure that you have sufficient capital that you can get to easily and it can be converted to cash to respond to those changing life events, even without any delay or taxes, penalties, or fees. Now, we're going to be talking a little bit about the different types of money and allowing you to look at your balance sheet through the lens of liquidity along the way today. So you can measure where you stand or where you're storing your wealth and what improvements can be made to improve the liquidity within the nature of your specific balance sheet. So specifically today, it's kind of an epidemic problem we're seeing across the country. More Americans than not, in this case, you say 2 out of 3 Americans struggle to come up with just $1,000 to respond to an unexpected life event. Think about some of the things we've already identified: college, homes, weddings, loss of a job. $1,000 is virtually meaningless in its ability to respond to those types of major life possibilities. So people are vulnerable and they have to turn to inferior sources of capital generally in order to get by and in order to withstand or survive an unexpected or even a planned life circumstance. So here are the kinds of things traditionally that people have turned to. Let's start here with credit card. Credit card indebtedness, yeah, it's at an all-time high. It's probably the first place that most people go when there's not enough liquidity or liquid capital on their balance sheet. They'll just charge things in order to pay bills and live life. So currently there's almost $1 trillion in credit card debt in America. Pretty big number. At the end of 2016, the short-term revolving high-interest punitive credit card debt is kind of out of control. It's like an out-of-control freight train for American consumers. It's very difficult to build wealth, real wealth, when the drag of short-term credit card debt is following close behind. So the next area that has to be considered, that is typically considered, is home equity in your primary residence. It's basically, if you think about it, it's kind of the same as credit card in your wallet. When life circumstances present themselves, people just basically cannibalize the equity in their primary residence, and this has been difficult and kind of a devastating consequence that we see in our day-to-day, what we see with our clients as we come across that. Home equity lines credit or indebtedness, homes in America, that's in excess of $450 billion as at the end of 2015. And again, this is climbing steadily as people are maxing out the credit cards, they're then turning towards a source of capital, which is a liquid level of capital embedded in their home. Another source we see quite a bit, perhaps when that isn't enough, student loans then. They have been utilized far too often by people as a means to help educate children. So in the United States alone, there's more than $1.4 trillion cumulative of student loan debt. And that's not a great scorecard for America, that's on an individual basis for sure, but it's a huge cash flow drain as student loan indebtedness is paid for and paid off, as opposed to the same cash flow that could be used for lifestyle or for perhaps wealth building purposes. And finally, 401k strategies. We see this as another source. Many people are taught to start right off the bat, enroll and max out your 401k plan. And there's a tremendous benefit to retirement programs for sure, which we would agree with. And 401k plans have their benefits, but yet it can be ignored that there are over $68 billion in loans on people's 401ks alone. So credit cards, home equity, student loans, 401k, these strategies, they're all with loans, and they all add up to what they should say is that there's kind of the worst way to respond to a sudden or planned life event. The more you understand the complexity or dangers of accessing capital in these ways, the more motivated you should be to save better, redeploy your cash flow so you have a better balance between your less liquid and more liquid types of capital.
So if you just look at where you are today and where you think you might go into the future, I want to give you the image here that our industry typically says you're here today. Let's look at what your tomorrow might look like. As if there's this sure path, there's this constant, clear pathway that will take you from where you are today to where you envision yourself tomorrow. If you just look at that from a pragmatic standpoint and place the planned life events on them in the sequence that they're more likely to occur. So homes and college and weddings for your children and then retirement, this timeline organized here, if you just consider this, the last thing you'd be doing is storing money for retirement, because that comes last in the scheme of things along the time horizon line. And when you consider the possibilities of an unplanned life event, it could occur at any time, right? The plot thickens and things become more complicated. So as you see, life doesn't just look like this. It's not a straight line. It's not just a narrow one-lane highway that takes you from today to where you hope to be tomorrow. Instead, it rather looks more like this. Life's filled with sudden turns, potholes. There's a host of unexpected and expected occurrences that you will face throughout your lifetime that will require you to obtain ample levels of liquidity. Step 3 today, what we're going over, is a very important element to achieving financial balance and overall financial success over the years. It doesn't result in a product per se. It's rather an issue of where cash flow, where your savings should go. Should it be buried in products where it's out of reach, up in that birdcage we showed you before, or should it be within reach to respond when that road turns suddenly so that you can respond accordingly? And let's look a little more deeply at the consequences of the 4 common liquidity sources that Americans, unfortunately, far too often lean on. As it relates to credit cards, it doesn't have to go any further than this. What sense does it make, and what progress is actually realized if you're trying to build wealth at 8%, while at the same time wealth is being pulled off your balance sheet at an 18% rate? If a credit card company is charging 18% non-deductible, you're moving backwards against the same money or cash flow that you're trying to move forward at an 8% taxable rate. The presence of credit card balances month after month and the interest attached to those balances is a devastating obstacle towards wealth building and actually damages your ability to respond to a sudden life event.
Let's talk about some specific problems here that we see in a little more detail. Student loan problems in one case. 1.4 trillion of loans, which we spoke about. That speaks highly as to the failure of college funding through the other strategies we spoke about. When you put money, for instance, in a 529 plan, that money is illiquid. It's off limits. It's not even in your control anymore. You're merely the custodian and can only be used for college tuition. When you put that money in an investment of your choice, subjecting it to risk, and the market will either reward you or take it away. So people, even though they want to invest in the market, they generally have a short-term time frame with which to prepare for retirement. So they're actually worried about risk that lowers the real rate of return, and they could enjoy inside of a 529 account. If you think of it, you're almost nearing retirement the same way you're nearing college as far as for your children. You're going to start to throttle back the risk on that, which could throttle back the return as well. And if the funds are not sufficient as people intend them to be, that's when the student loans present themselves as the only other viable alternative. And it's the debt, unlike credit card debt, or not, again, that's not dischargeable, and that credit card debt will follow you and your children over time and not go away unless they're paid off completely. So also problems as it relates to home equity. First you have to qualify for home equity loan. Then there's the appraisal of your house. You have to deal with the lender to make sure that your income and overall finances are suitable for them to loan additional money to you, and then you'll use your home as collateral, basically. And there's a limit as to how much they will loan. They can change the interest rate as to what they're loaning you on a quarterly basis. You have to maintain a relationship between how much you owe total how much you owe total on your primary mortgage and your home equity line, and as it relates to the current value of your home. So you have to manage that as well. And then you'll, of course, obviously have to pay the loan. If you don't pay in full and you fall into delinquency, and then obviously in the long-term worst case, you could lose your home. So the presence of home equity lines in America has affected people's ability to sell their homes. Housing prices have gone way up, and then they've gone way down. Some of you have experienced this, and then you have to kind of struggle to recover. Therefore, when you have additional debt beyond the primary mortgage, it eliminates flexibility for you to stay in your home, refinance your home, or move into a new home in the future.
So turning to the 401k plans, it's a complex thing, right? There's a limit as to how much you can borrow against your 401k plan, and there's a specific payback schedule that must be adhered to. If you don't walk the line and follow the rules and play by the rules, then there's a possibility of default. This would trigger a penalty of 10% in income taxes on everything you borrowed from the plan. In spite of these drawbacks, in spite of the fact that this is an unattractive place to get liquid capital, it is a commonly used source to respond to a life event. Actually, 1 in 5 people have had a loan against their plan at any point in time. So in a 5-year period, 2 out of 5 people have had a loan against their 401k plan. So perhaps what's not understood and potentially most damaging is this whole lack of understanding around the double tax situation that occurs when you borrow against your 401k plan. So let's talk through that so you understand that it's probably not something you'd use as a first choice, but as a last resort. Here's an example on the screen of a loan going out on a 401k plan. You borrow from your retirement account, and now you have to pay that money back with an after-tax income that you're earning during that year. So if you're borrowing $10,000 in order to pay back the $10,000, then you have to earn more than $10,000. Pay tax on that to end up with the $10,000 put back in the plan. So that's the first tax. Now that the loan has been paid off and the after-tax amount has been put back into the plan, those dollars that have been subject to income tax once will someday come out to you as a retirement withdrawal. So this is important to understand here. And that same dollar that has already been subjected to tax will now be taxed again. So there's 2 taxes. This double taxation phenomenon is not widely understood by consumers, okay? And if it was, they probably wouldn't consider borrowing against their 401k plan, certainly not to the extent that we see running so rampant today. So that's very important to understand, that when you take a loan out, it'll be taxed at that time as you pay it back, but then also taxed again when you pull it out for retirement. We've spent the majority of our time talking about the importance of being liquid, the fact that life changes, the fact that you have planned events in your future that you know you're going to have to be addressed. And in addition to that, there are things that you don't know that can be equally as substantial and can be even more devastating that are going to require you to be in the proper liquid position. So the liquidity makeup of your balance sheet is critically important to you maintaining the right level of financial balance. And to someday look back and say, you know what, we made it. So the question is, what asset balance do you have from a pure liquidity standpoint? What does that look like? This is not asset allocation. This is going to be talking about liquidity allocation. Let's do this exercise again that you might have already done on your private Wealth Steps website. If you haven't done so, obviously Tim had already mentioned, take a look at that. So let's play this game. Let's rank liquidity and let's understand the difference between different asset categories. And here are the choices. We're going to do a poll in a second here, assembled in random order. You have your 401k plan, you have any cash value life insurance you might have, and permanent life insurance policies, equity in your home, money in the bank or investments or mutual funds or stocks and bonds that you own personally. They're not a part of an IRA or part of a retirement program at work. So now we'll start with the poll. There's one poll today, and Aubrey, you can go ahead.
Perfect. Yep. So the poll question for you to select your responses to should be on your screen right now. Please select one of those responses. We'll give this about 30 seconds or so more to collect the responses, and then we'll share the results with all of you.
And I'll read the question. The question is, which of the following assets would be considered most liquid? A is 401k, cash values, real estate equity, bank accounts, and mutual funds.
Okay, and about 10 more seconds to get those answers in. All right, and let's close this and share. We had about
Pretty easy, right?
Yeah, we had about 70% on the webinar today respond to this poll, and all of you had the exact same answer. So,
well, it's excellent. So everybody's correct, right? Great job on that. And we'll kind of look at the liquidity and what the correct order would be. So everyone's right. And we've talked about this, just the enormous exposure that might exist if you're not properly positioned from a liquidity standpoint. What would be the most liquid to the least liquid all the way down? And this is ranking that from top to bottom, most liquid all the way down to the bottom to the least liquid. So great job. That's the correct order and hierarchy that you should start becoming accustomed to dealing with in your personal financial decision making. Bank accounts, cash values, investments that you own personally. Then in the fourth slot is 401k or retirement accounts, and finally real estate equity. So if people understand these 5 categories and the order from a liquidity standpoint, then all of a sudden their cash flow decision making is much more clear and much more powerful when they have to make those decisions throughout life.
So let's take a look at an optimal liquidity rule that we look at and we talk to our clients and that we hear out that we kind of position ourselves to. What is your objective? What are you trying to achieve when it comes to liquidity? Well, we look forward 9 to 12 months on your balance sheet of your annual gross income, and that's what we consider optimal. So, as an example, if a person makes $100,000 a year, then 75 to 100,000 should be on your balance sheet, not tied up in a qualified retirement plan, not tied up in home equity, but in bank accounts, cash value life insurance, personally owned investments, money that you can get to without delays, without taxes, without fees, and without penalties. So think about this for a second, because this really doesn't have anything to do with the rate of return. All of you probably realize that the money you have in the bank is earning less than 1% in interest each year, and it's also taxable, so virtually no growth. But even with that being said, how would it make you feel? How would your life be a little different if you have 1 year's household income in your checking account earning 0%? Well, what kind of decisions can you make that you can't make today, and what would your financial confidence amount to if that were the case? If you can add that feeling, if you can add to that feeling, you say, well, okay, it's there, but there's no rate of return. What if you can add a little rate of return and some tax advantages? Well, then that's even better. But it's not as much about all of that as it's about being liquid, about being flexible, about being able to respond to a changing world that's in front of you. So here are your choices. This is what it looks like from a balance perspective, a balance standpoint, visually. You have bank accounts, you have investments that you control, and cash value insurance that has a host of features that are unique and important to you. These are liquid choices. So we break it down in a pyramid. This is how it breaks down. This is how you can put it in relationships, so it's not just $1 in every category. In an optimal world, you'd have money in the bank, but maybe you'd only have 15 to 20% of liquid capital in the bank. The rest would be deployed into investments that you own and into cash value life insurance, because those are more powerful. And while they're also more liquid, they have more liquid, from a wealth building perspective as well. So that, and this pyramid here kind of puts you in control, puts you in more of a control position. And you have to be in control, really, if you're going to be in the best possible position to have to respond when life changes its mind. So if you have this picture in your mind with this triangle, with some pure, immediate access to cash in the bank supported by investments and cash value, it's an image that would serve you and your family well over the long period of time.
So let's look at the features of each of these. Let's drill down a little bit more deeply to allow you to see why that triangle is assembled the way it is. And so let's look at the features of these from a standpoint of liquidity, rate of return potential, the impact of taxes or tax avoidance, and then finally risk. So ideally what you'd want is something that is liquid with a high rate of return that doesn't trigger tax and is not risky in any way. That's ideal. So let's see how these three choices measure up to that standard. So as it relates to liquidity, they're all liquid, right? So we've been saying that, and we continue to drive that point. This is where your cash flow and world-class savings should be deployed until you get to the point of having close to a year's worth of liquidity on your balance sheet. From a rate of return standpoint, money in the bank is not enjoying a very high rate of return. So while it is liquid, it's actually losing ground as it relates to the impact of inflation and other forces that make up the real cost of living. Whereas insurance cash values and investments move over time in a more powerful manner, creating a rate of return that does battle with the real cost of living. As it relates to taxes and tax avoidance, both bank accounts and investments trigger 1099s every year. So whatever the bank or investment portfolios return every year, you have to pay a piece of that to the government each year and only get to hold on to the after-tax amount. In cash value life insurance, there is no 1099, there is no tax. It is liquid, and it has a rate of return, and part of why people like to own it, if they do, that type of property is because of the tax advantages built into it. And from a risk standpoint, things change once again. So money in the bank is safe, federally insured. Money in the stock market could disappear in a day if the market goes down, so there's risk there. It could go up, but it can also go down. And that's why we've assigned a yes answer to the risk category. In the middle, cash value life insurance is liquid. There's a rate of return. There is no tax. There's no bad day. There's no risk in putting money into life insurance policies from a market volatility standpoint. It's a non-correlated asset to the market. So we're not saying to have all your money in one particular area, but it is important to know that individual characteristics of each of these categories that make up what your liquidity pie looks like. This is why the top of the triangle that we showed you, bank accounts, and then predominantly investments that are strategically orchestrated, combined with cash value life insurance, gives you this tool of liquidity that has what may be the best of the best. So the potential for the best rate of return, the total amount of liquidity, and the best chance to avoid taxes, and the least amount of risk in the overall. So when you're liquid, there are a host of benefits that automatically turn back. If you have a year's worth of liquidity on your balance sheet, shouldn't you raise your deductibles so that your insurance premium cost every month would go down? Self-insure a little on the front end so that in your premiums, each month can be lower than higher. People who strap from a liquidity standpoint can't do that. They need to have low deductibles so that they're actually overpaying on their insurance costs through that time period. So if life changes its mind and you need capital, you don't have to go to a credit card company or a 529 program. You don't have to ask a lender what the terms are on a HELOC, home equity line. And you don't have to talk to your HR department about the complexity around borrowing from a 401k plan. It's just your money. You can deplete to respond to life and replenish it based upon your pace and your life's circumstances. So opposed to corporate America writing the rule back and forcing you to play their game, right? Giving you more control. So this gives you an improved level of control, like we just said. The more you can stay in control with your life and the ability to respond to a changing life, the better off you'll be in the long term and short term. Certainly taxes will be lower if you're liquid and you've taken advantage of the tax advantage products that you can control. The fact that you have lower insurance costs, you're financing the addressing life events with your money rather than commercial lending, the increased control lowering of taxes, avoiding risk. All of this, we know from working with our clients, injects an improved level of financial confidence in our clients' lives. Life just feels better when you're confident.
So let's take a look at all of this from a seesaw perspective. You know, perfectly balanced asset domain, not asset allocation, but more of an asset domain, everything put in place. So take what you have in the bank, add your cash value life insurance, add your personally owned investments, and that's all on the left there. And you have that amount add up to be the same amount that you're storing in your retirement plan for future retirement and real estate equity on the right. So that image, the pursuit of that image that you see there, that will have all the benefits of being properly liquid. So here's what it looks like if you're properly protected and you become a world-class saver, which is the things we've talked about in the first couple of weeks of our workshop here. So now so here we are at step 3. There's no cost really to step 3 if you've taken care of steps 1 and steps 2 properly. It's just a matter of where the newfound improved savings should be going. So just reallocating those dollars at cash flow. So people are pouring most of what we see when we normally come into play with someone and a client. Most of the clients we see when we first engage with them, this is where we see what we see when we arrive on the scene. They're pouring most of their cash flow, maybe too much of their cash flow, into their home, maybe too much into their 401k plan, or plowing it too much into debt. Maybe credit card, student debt, borrowing from the home. This is the diminishing amount going into the savings or liquid type of investments. What you should be thinking about, and this is what we can help you with, and we can talk to you more to set up a consultation for you to kind of explain to you how, this is part of what the value of wealth steps can do for you, where Ray and I bring the value to the table, is we can show you some more detail as to how to get to this proper balance that we speak about as far as getting your liquidity in the right order. You take the same amount of cash flow, simply reshape it. Let's start to dial down the spigot going into the size of your home, and how new your car is, how much you're putting into your retirement, which is 30 to 40 years down the road perhaps, and how fast you're paying off your debt. Let's see what that does, see what those steps do to improve and increase the amount of newfound cash flow that allow you to be that from being a world-class saver, and that brings you to a different reality, and how to ensure that that new savings goes into the most liquid types of property that you have out there, different types of strategies, possibly into the bank or investments you control, or into cash value life insurance, those type of things. Again, we can show you in a consultation how we can set that up for you, and then get into more specifics and some more detail than perhaps we'll get into today with the large group on the call. And here's some of the action items you can take. So make sure you've taken the proper steps to become green and optimal in steps 1 and 2, which we spoke about the last couple of weeks. Protect your todays first, then become that world-class saver. And then this is what might happen today. 15 to 20% of what you make, the more you make, the more you save. Next, add step 3, which we're talking about today. Directing the step 2 savings into vehicles that will allow you to be properly balanced, to be properly liquid, to have a year's worth of income in liquid property or more, and have an amount in liquid capital similar to the amount that it will have less liquid, like we've been speaking about earlier. If you do that, you monitor, review all these regularly as your lifestyle and income changes, and as life changes around you, as these events that involve your world come into play, you can expand your level of financial confidence. Things will happen, things you couldn't imagine will occur, and then you can think about, you know what's in front of you and how you will someday have to address. You'll be able to approach both with the confidence that you're prepared, and you'll be okay. Step 3 is a critically important element to establishing the proper financial foundation in order that the financial future will unfold no matter what life has up its sleeve for you.
So today's presentation is shorter, and this is the summary. We're going back. Those are the action items for this week. But coming back to the summary, the value of wealth steps, making sure that as many of you can take advantage of that. It's private to yourself. You can take it, so it's a kind of a guideline. And if you want a consultation to review that or have some strategies or questions for your personal sake, please reach out to us. We'd love to help. And this is what you get when you go through the well steps. So we just want to make sure we're harping on that, because this is really the value of what well steps we're doing through University of Maryland Alumni. This is what really is going to get you to where you want to be, or give you those stepping stones of where I can do better, right? Going from red to yellow, and then finally, hopefully, everything will go to green, right? It goes over life insurance, disability insurance, your liability coverages in your car and home, wills and trusts. Many times those aren't updated. That's where we see the yellow there. They should be reviewed. Making sure you're saving enough, 15 to 20%. Most people don't. They save less than 5% on average. Step 3, having those life event funds we just went over today, right? Making sure that we can get liquid position. Many people are reverse. They have too much money that's illiquid, and very few dollars in their savings or liquid positions. And then finally, 4, making sure that the mortgage, making sure the mortgages are properly structured, that you don't have too much house or too little house. Typically, we talked about that last week. 15% of gross earnings is somewhere we kind of reference point for a mortgage. And then short-term debt. Obviously, we just went over some statistics. It's just kind of a epidemic in our country, making sure there's a strategy to pay those down. So this kind of gives you that color code, simple. And if you follow things in those 4 steps, you're going to be able to make yourself and get yourself into a better financial situation. So thanks for your time today. Tim's going to say something here.
A couple reminders for you as well. We do well steps. We do them with individuals. We set this up with businesses, and in this case, it's the Alumni Association we set it up with. There are some PDFs that are available to you that will be forwarded to you as a follow-up to this as well. We encourage you to take a look at those. They get into some detail with regards specifically to today's presentation on building a life events fund. One of the specific PDFs you see in there is really targeted towards business owners. It's what they call a buy-sell checklist. So if you happen to own a business or know someone very well who owns a business, it's a very valuable tool that can be used, which can address them from a business planning perspective, but it's all tied to the Well Steps philosophy that we go over through our workshops. So we encourage you to do that. We also encourage you to follow up to the survey that'll be sent to you at the end of this program each week. And we also encourage you, obviously, to come back and join us next week. But we're going to and again, we can provide you with this value-added, no cost to you consultation that we can provide you with.
And the handouts that are on the call will be sent to you in that follow-up email, which are based on what we spoke about today. So one of them is called the Complete 401k Picture. Experiencing Life Events is a second document. Myth of Compounding Interest. And then the last PDF is Understanding Liquidity. So make sure you take a look at those. They're 1-pagers, mostly maybe 2 pagers at most. They're just good reference points for today. So that's it. And then now we'll take questions.
We'll open up the floor to some questions. Aubrey, if you'd like to explain how that works.
Absolutely. Thanks so much, Ray and Tim. Like I said, we'll go ahead and take some time for questions right now. If you do have a question, please type it into the question box that's located in the GoToWebinar control panel that you have on your screen. So we do have a question regarding the investments portion of the liquidity pyramid. So it was mentioned that ideally these should be no or low fee and commission. But even some low-cost trading platforms like TD Ameritrade and E-Trade have some level of commission. So can you clarify what it means by no fee personal investments?
Yeah, well, basically what that means is it's the amount of fees you would pay depending on who you're working with, as far as whether you have a fee on a brokerage account or a non-fee as a managed account. But really, for the purpose, what we had in the pyramid that we had set up there was the investment portion of it is really just generally investments. Now we do break that down when we sit with a client. That becomes a little more detailed, specifically with, the asset allocation model that most people are familiar with. And then we talk about, funds that have fees. We talk about bonds versus stocks and how that's all allocated within that specific portion on the investment side of it. And that's how we kind of break it down a little bit. We kind of group that all together from a liquidity standpoint, which is really what we're talking about today as it relates to liquidity. But yes, there are different platforms that can have, like I said, no fees as far as the investment side of it goes, whether it's mutual funds or stocks or whatever you have that's available. Again, the point of that was really generally just to show you, in essence, non-qualified money that's not tied up in a taxable retirement account. I hope that answered the question.
Perfect. Yes, thank you. And can you clarify why cash value life insurance ranks higher than mutual funds on the liquidity ranking scale?
Basically, I don't know if it ranks as much higher, but really it's still liquid because in essence, in some cases, you don't necessarily have to, if you have money in investments, sometimes they're invested in stocks or mutual funds. In many cases, you may have to sell those first, put them in a money market, put them in cash, and then have that cash made available to you. Again, there's no necessarily a fee or taxes made necessarily to do that perhaps, but it's just one extra step in essence. Sometimes you may have to sell those investments first, then make them cash, then basically take the disbursement from that account. Whereas cash value is just cash, where simply it's the cash value is you call up the insurance provider, say, hey, could you please forward money to me or send me a check or wire that to my account, is technically one less step. And again, it's more from a liquidity standpoint. It's just that one less step you have to take. It's not a major step as far as selling the assets as far as an investment account, but sometimes that'll take an extra 1 or 2 days before it clears, before that money is actually available to you.
Perfect. Thank you. And we do have a question about the recording of this presentation. So yes, everybody who is on the webinar today will be receiving a follow-up email from me later this afternoon. It will include a recording of this presentation as well as the handouts that you'll find on the control panel of your screen, the Wealth Steps link to create an account, and a survey to fill out as well. So all of that will come from me. Whether you are able to join us next week or not, we will be sending a recording out to everybody who has signed up for the program. So you will have all of the information that you need in case you are not able to join between the 12 and 1 p.m. hour. So I'll give about another minute here just for any late questions before we wrap up. But Tim and Ray, is there anything else you want to just cover or touch on really quickly while we give some additional time for any questions to be typed in?
Sure, absolutely. We just want to remind everybody that next week's presentation will deal with addressing debt, tackling debt, how to try to maintain a debt-free balance sheet moving forward. And again, the reason that we're showing these, it's all progression. For those of you who have been with us through these 3 weeks, you understand there's a reason we do these in the order that we are addressing them in. It's protecting your todays, becoming the world-class saver, and it's dealing with having money set aside, liquidity for life events funds, and then addressing the debt-free, the debt you may have moving forward. So we welcome you to join us next week, and again, we'd appreciate you guys coming back, and certainly appreciate the time that many of you put in already. We know it's everybody's got a busy life, especially this time of year, so we certainly appreciate what you've been able to do with us so far.
Yeah, we just hope it's bringing you some value, and that's where the survey comes in. So thanks for everybody logging on.
Absolutely, absolutely. It looks like we've covered all of the questions that we have today. Again, if you have a question that you want to take offline or connect with Ray and Tim after this webinar, please feel free to reach out to them. Both their phone numbers and email addresses are listed on the screen. We'll also be sending that follow-up email with their contact information as well, so please feel free to get in touch with them if you would like more information or want to discuss your own personal situation. We're about to sign off here. I just want to thank everybody so much for joining us today, and we hope that you'll join us for our final week of this series, which is next Wednesday, May 30th at 12 p.m. Have a great holiday weekend, and we will see you next week. Thanks so much. Go Terps.
All right.